For years, buying the Magnificent Seven was the default trade for anyone wanting tech exposure. As of May 2026, the idea that these 7 stocks move together as a safe, unified group has completely shattered. Holding a generic basket of mega-cap tech now means you're accidentally holding underperforming assets. The sector has fragmented, and the gap between the winners and the laggards is widening. This chart shows the year-to-date performance. Alphabet is up 23%, but the real standout is AMD, which has surged nearly 60%, as the market prices in a massive gain in server and GPU market share. Now, look at the bottom of the chart. Microsoft and Tesla are both down double digits. Simple AI adjacency is no longer enough to support a valuation. If the earnings anchor isn't there, the stock is being sold off. Investors who stick to the old Mag 7 strategy are effectively paying for the cash burn of the underperformers, missing out on the concentrated gains of the companies actually capturing AI revenue. The market is currently separating these companies based on capital efficiency. Narrative hype is being discarded in favor of visible, high-margin returns. This divergence is fueled by unprecedented spending. In 2026 alone, the major hyperscalers planned $725 billion in AI-related capital expenditure. That massive figure has created a specific risk for investors: the AI Capex trap. This funnel tracks that $725 billion. One path leads to revenue capture, where infrastructure immediately generates cloud backlog. The other path leads to cash burn, spending that increases depreciation and drags on margins without a clear timeline for a return. This is why cheap valuations can be deceptive right now. If a company has a massive spending overhang without a clear ROI, that lower PE ratio is often a warning, not an entry point. If you don't account for how a company is spending this capital, you won't understand why highly profitable names are seeing their stock prices suppressed, despite beating earnings expectations. To navigate 2026, capital allocation should be based on the visibility of a company's monetization path, regardless of its historical status. The first group in this split is the infrastructure sellers. These are the picks and shovels, collecting their revenue up front as the $725 billion build-out occurs. NVIDIA remains the dominant platform here. They are the primary toll collectors for the entire AI compute stack. Owning NVIDIA gives you exposure to the most secure ecosystem in the space, but it leaves you vulnerable to the eventual normalization of their margins and the long-term threat of customers building their own custom silicon. That shift toward custom chips is why Broadcom has become a core infrastructure play. They provide the networking and ASICs that hyperscalers use to manage their own supply chains and reduce their reliance on NVIDIA. This chart shows the premium investors are paying. Broadcom's PE multiple is 103, double NVIDIA's 48.6. You're getting custom silicon exposure, but paying a premium. AMD, the highest beta challenger, is even higher at 168, pricing in major market share gains. The momentum in AMD is significant, but it carries the highest execution risk in the tier. Any sign that they aren't capturing durable market share would likely lead to a sharp correction. This tier offers the most immediate revenue, but it requires investors to accept very high valuations and almost no margin for error in execution. Tier 2 is the cloud monetizers. These are the companies buying the hardware and attempting to turn it into profitable enterprise software and cloud services. Alphabet stands out in this group because it has successfully paired cloud acceleration with a valuation that hasn't disconnected from its current earnings. Alphabet offers a reasonable PE of 29.2 and strong AI search resilience. The trade-off is the ongoing regulatory pressure, but their cloud backlog provides a more visible ROI than many of their peers. Amazon also has strong leverage through AWS, but they have a second layer of monetization, using AI to drive massive automation and efficiency in their retail and logistics business. That dual leverage creates high operating margins, but it does mean Amazon remains vulnerable to consumer spending cycles that can mask their cloud growth. This graphic shows the current debate between the two largest players. Alphabet's side of the scale is weighted by visible cloud revenue. Microsoft's side is currently unbalanced by massive capital spending on Copilot that is yet to show the same level of monetization. Microsoft has a deep enterprise moat, but the stock is under pressure because investors are questioning if the current adoption of Copilot justifies the scale of their infrastructure build-out. Oracle is also in this mix as a tactical play, benefiting from high OCA demand, though it carries more balance sheet and financing risk than the larger hyperscalers. The takeaway for the cloud tier is that the market is only rewarding platforms where the incoming revenue is visibly outpacing the upfront spending. Tier 3 includes the optionality names. These companies aren't selling infrastructure or cloud services. They are betting on future consumer devices or speculative software breakthroughs. Apple is often viewed as a defensive play, but in this cycle, it functions more as a quality trap. You get the safety of the iPhone ecosystem, but at a 33.5 PE, you are paying a premium for a company that lacks a clear AI-driven earnings acceleration story compared to the cloud leaders. This ledger illustrates Meta's specific problem. Their capital spend is massive, but unlike Amazon or Alphabet, they lack a cloud business to offset that cost. All of that AI infrastructure has to be justified purely by ad efficiency. Meta's ad business is strong, but they face a credibility issue with investors. Without a direct way to monetize their infrastructure, the market is skeptical of the ROI on their multi-billion-dollar spend. Tesla represents the most extreme version of this optionality risk. This radar chart shows the disconnect. Tesla's valuation axis is stretched by speculation on robotics and autonomy, but its current earnings anchor is tiny by comparison. At a 360 PE, the stock is priced for future success that isn't reflected in today's auto margins. In a high Capex market, promises of future breakthroughs are being discounted. Emotional attachment to a brand won't replace the need for visible returns on capital. To translate this split into a strategy, you must isolate the companies capturing revenue from those still selling a narrative. One way to express this thesis is a pair trade: long Broadcom and short Tesla. A long position in Broadcom targets immediate cash-flowing infrastructure orders. The gears produce tangible output right now. Conversely, a short on Tesla bets against unproven autonomy timelines. You move capital away from speculative progress bars toward tangible production. This trade isolates the monetization theme. However, it does introduce specific risks, such as Broadcom's customer concentration and Tesla's potential for non-AI-related automotive recoveries. By using a structural pair trade, you can cut through general market volatility and focus specifically on the divide between AI revenue and AI promises. Rebuilding a tech portfolio for 2026 requires a strict focus on how efficiently these companies use their capital. For the core foundation of a portfolio, the evidence points toward overweighting Alphabet, NVIDIA, Amazon, and Broadcom. This path offers the highest certainty of current revenue generation, though it does mean you are likely capping your exposure to more speculative, high-beta breakouts. For more aggressive growth, AMD and Oracle provide high-beta momentum, but they come with significant execution and financing risks that must be managed. This matrix categorizes the names to avoid or underweight in the red box. Tesla, Meta, and Apple currently lack the direct AI monetization or the Capex credibility required to be core longs in this cycle. The $725 billion build-out has changed the rules. It is no longer enough for a company to simply mention AI. The market is now demanding proof of pricing power and infrastructure scarcity. Winners in 2026 are defined by defensive returns on capital. If a stock's value depends on long-duration optionality rather than immediate monetization, it is likely on the wrong side of the megacap split.